For the week ahead, the important event is the June 19th, Wednesday, meeting of the Federal Reserve's Open Market Committee. The Fed is really the last of the three main central banks to report, to meet for this cycle. The first two have been pretty disappointing, and the market has reacted with disappointment. So really, the Fed meeting is the last chance for one of the banks to do something that's going to make the market feel good. I think the likelihood is the Fed's not going to do that. The market's going to wind up feeling bad, and the central banks are going to basically deliver an 0 for 3 batting performance. Okay. First one was the European Central Bank. The European Central Bank did nothing. Didn't raise rates, didn't lower rates, didn't add any new programs, nothing. And the market said, well, wait a minute, we're in the middle of a recession. And the bank said, basically, yes, we know, but we see growth coming down the road in 2014, and that's good enough for us. And the market said, well, we don't see the growth for one thing, and even if we did, it wouldn't be good enough for us, so the market went into a kind of funk. The next bank up was the Bank of Japan. It sort of sounds like the Three Billy Goat Gruffs with the troll under the bridge. Okay, so the Bank of Japan had a meeting and basically did nothing. It's not that the Bank of Japan hadn't done anything before. They've got about $760 billion worth of expansion of the money supply in Japan on the books, but the market said, well, we know about that. We've known about that for a couple months since April. We announced it in April. So give us something new. We've already figured that into prices. The Bank of Japan said, well, no, we're not going to give you anything new. We'd like to see how this plays out for a while. And the market basically went into a kind of snitty fit. Okay, so the Fed is up. One last chance, and I think the Fed is also going to disappoint, because the Fed is probably not going to say what the market wants. The market right now would like the Fed to say, hey, we're not going to reduce our $85 billion in purchases of treasuries and mortgage-backed securities until December. The Fed isn't going to say that. What the Fed is likely to continue to say is, when we see the data, we'll adjust our policy. What the Fed has said is that when they see evidence that the economy is going to be able to reduce unemployment to 6.5%, they'll consider cutting the amount of treasuries and mortgage-backed securities they buy. Until then, this policy remains intact. The market has sort of talked itself into fear that the Fed is going to cut sooner rather than later, that they're going to start to taper off maybe in June. There's a June meeting, this one, or maybe July. I think that anybody who's still counting on the June meeting is smoking Ulysses S. Grant bills instead of tobacco. But the thing is that the Fed would not like to nail itself down to anything, because the data is very, very fluid. The economy is growing, but not very robustly. So the Fed doesn't want to really give the market anything. It doesn't want to reassure the market, because it doesn't want to talk up the market and then have to talk it back down later. So I think on the 19th, the Fed basically says, well, what we've told you is what we're going to tell you, and the market is disappointed once again. This is Jim Juback for the MoneyShow.com Video Network.